My name is Randy Melzi, and I'm Senior Director of Public Policy Programs and Corporate Relations at the Americas Society and Council of the Americas. It is my pleasure to welcome everybody here tonight, as well as those watching us through our live webcast. Thank you for joining us. A special thank you to Telefónica, our webcast sponsor. When we thought of this panel a few weeks ago, the media headlines were all about the emerging markets rout. And so we decided to call the panel Emerging Markets Volatility, Contained or Contagion. Thank you, Ralph, for the title. Today, the headline at 2 p.m. in the Financial Times was Global Stocks Gained Ground for the 9th session in a row as optimism over China's growth prospects and waning emerging market tensions boosted investor risk appetite. So the question we're asking ourselves today is, are we out of the woods, or is this a calm before another storm in emerging markets? And today I read a new phrase that I'd never heard of, which is the Fragile Five. Our panelists this evening are Ralph Davidson, Chief Equity Strategist, Itaú Private Bank International, Luis Oganes, Managing Director, Head of Emerging Markets, Local Market Strategy, and Latin America Research at JP Morgan, Lúcio Vinhas de Souza, Sovereign Chief Economist, Moody's Investor Service, and our moderator is Viviane Rodriguez, Capital Markets Correspondent, Financial Times. Thank you very much for joining us, and Viviane will leave some time at the end of the panel for all of you to ask questions. Thanks. Viviane, over to you.
Okay, this is working. Thank you for coming. And I think I'm to blame for that headline. I just made it myself, slightly more difficult for me. But we have a great group of people here that I think that together we have at least several decades of experience, either working or living or covering emerging markets. And I think the topic is very relevant. It's a particularly challenging time for the asset class, I would say, because trying to determine whether, we are really seeing a change in the outlook for emerging markets. How serious is that? How deep is that? And what are the implications of a prolonged decline in asset reevaluation, and could be very, very detrimental not only for emerging markets, but also could have very dire implications for developing nations and for the entire globe. So the idea here is to make this debate as lively as possible. We're going to give actually ample time for questions and answers. Just want to remind the speakers that we have several members of the press in the audience, myself included, so most of everything is on the record here. So I'll start with something very basic, but I was just trying to figure out here, and I probably will start with Luis. If you think that, if the fundamentals of emerging markets are really as bad as some of the price volatility that we have seen in the last couple of months.
Thanks, Vivian. I think that the market moves are exaggerating the degree of deterioration in EM fundamentals. I think EM fundamentals are not looking as bad, but this doesn't mean that the fact that we're having these market pressures, it can have some kind of self-fulfilling component that in the end ends up affecting growth, ends up affecting balance of payment and fiscal dynamics in some of these countries. And what starts as something that is not justifiable ends up, validating, the price action, meaning that you do see a fundamental deterioration. When we see emerging markets overall, it is right now kind of caught between two forces. One is a recovery in the developed world, which is happening, US, Europe, Japan. And the other one is the drag that is coming from China. And emerging markets, some are more linked to the developed world, some are more linked to China, but they are caught somewhere in between. And the problem is that the recovery in the developed world so far doesn't seem to be generating this pull factor for emerging markets as much as the drag factor coming from a deceleration of China. So EM growth is not recovering yet. We have an average growth projection of 4.5%, 4.6% this year, exactly the same as last year, even though DM growth, the developed world, is going to probably double in the growth pace, from 1.2 to 2.1. That's our projection. So very little pull.
I mean, it seems at least at the beginning of the year, the brunt of the movement has been in emerging market currencies.
Yeah.
I mean, obviously, this is also related to the fact that they move faster. And but I wonder if we, just by seeing some of these currencies really weakening, I mean, we are really generating kind of a self-fulfilling prophecy in some of these more vulnerable emerging market economies. I'll give you an example, for example, Brazil, for example, or Turkey that have seen Indonesia, who have seen the currency really, move and weaken in a very sharp period of time. I mean, how that, and that perhaps is something also that both Louise and Ralph can bring it to the table here, how that actually really jeopardizes some initiatives to keep economies on track, especially when a lot of these emerging markets are trying to grapple with inflation at the same time.
Well, the outflow of money that we have seen so far this year from emerging markets is massive, around $10 billion out of EM fixed income markets, around $27 billion from EM equity markets year to date. We're talking about 6 weeks into the year. This is massive. Last year, in the full year, we had around $28 billion of outflows from EM equities. So in 6 weeks, we have seen the same size of outflows. So of course, there's a lot of pressure on currencies. And currencies, the problem is that some countries are being forced to increase interest rates to contain this currency pressure. We have seen that in Turkey. We have seen that in South Africa. We have seen that in Brazil, that wanted to slow down the pace of tightening, is being forced to keep 50 basis points per meeting. And this is going to have a growth implication. So that's what I was saying. So your initial question, is this justified? I would say, from when you look at the macro fundamentals, I would say that probably not. But the problem is that we've gotten into this cycle of negativism that is now delivering tangible negative implications for many of these countries.
I think what a lot of people still find it, quite baffling about all the sell-off is that if something triggered this, if we had one trigger in particular, some point to some problems in Argentina when we had the peso kind of trading, or the government just letting the band go, or the protests that if it was kind of a build-up, or suddenly one or two events, could be even the taper here, was just, you suddenly have a gigantic shift in flows directions overnight. My question was why? Why now and not 6 months ago? Because both of these economies were already facing, the similar situation that they are today.
Well, in that particular case of Argentina, I think it was almost like pure coincidence that the devaluation happened in the week where everything was selling off. I think that devaluation could have happened any time, because Argentina for a very long time has already been running an unsustainable policy mix. So at some point, the pressure, the loss of reserves implied by this defense of the currency had to give in, and it just happened at a time. But the headlines about Argentina triggering a global sell-off was certainly, from a point of view, exaggerated, because the connection, Argentina, is not in the MSCI EM equity index. So in the fixed income benchmark, it is less than 2%. So even if Argentina implodes, it's not generating losses for investors of a scale, forcing them to sell something else to compensate for that loss. So Argentina in itself doesn't have at this stage the power to generate the sell-off. Yet we did have this confluence and coincidence of many things happening, and protests in Ukraine, and certainly Venezuela having its own share of issues. That all of a sudden all the headlines were EM is imploding, but it was a lot of idiosyncratic factors, and again it was a coincidence.
We also seen the equity markets really respond very aggressively. I bring Brazil to the case because Brazilian equities have been suffering for quite some time. And so where is the chicken and the egg here? Is the currency market goes first, the flows go out, but people just stop believing in the companies in these markets and take money out of the stock markets? And how detrimental, again, to see your benchmark stock index pretty much the verge of collapse here have for the outlook for these economies?
Well, I'm going to address Brazil first, and then I'm going to go to the macro, because I have this slide up But in Brazil, I think they definitely face challenges. You've got, in a very simplistic sense, two sets of Brazilian equity investors. You've got Brazilians and you've got non-Brazilians. And the non-Brazilians have looked, they're global asset allocators, and they'll look at a slide like this one, which basically shows that developed markets have been outperforming developing markets for the last 3 years. And they say, well, okay, if I'm going to go into developing markets, where do I go? And when you look south, whether you're sitting in the US, whether you're sitting in London, whether you're sitting in Geneva or Tokyo, and you look to South America, you're looking at a complicated situation in Brazil. It's been complicated because of inflation. It's been complicated because of growth prospects that didn't come to fruition. And so you say to yourself, gee, there might be easier places for me to invest my money. So that leaves you with the Brazilians. I spent last week in Brazil speaking with our high net worth Brazilian clients. And what I found is you're getting to a level of frustration. And I think that's your point, where they look at CDI, which is basically their benchmark savings rate, which is now 10.5%. They say, why am I going to put my money into the stock market if I have to generate 10.5% plus some equity risk premium above that, when really I've had negative returns recently? Why do I want to do that? And they're almost throwing up their hands in frustration and saying, I'm going to take my money, or consider taking my money from the Bovespa and putting it into CDI. So that's where they stand now. So there is the potential that as these people take their money out, that there's the potential for another leg down. So I would say that from 70,000 in the Bovespa down to about 40, 45, 48,000 where we are today, that's the foreigners coming out. And then to the extent that the Brazilians actually take their money out, that there is that potential for another leg down. And the reflexivity, I think George Soros would call it, that you described, where it actually, the market events become economic and actual fundamental events actually take hold as well.
Do you see that in other portions of,
Well,
the asset class, or Brazil is a particularly challenging place?
Well, I think that, if you look around globally, again, this is developing markets underperforming. And there are regions where the prospects are very, very interesting and or improving. I think, though, that whenever you're talking about the asset class, you need to talk about China, unfortunately. And why is that unfortunate? Because it seems sort of trite. I think people have been talking about China and the China risk now for, 8 of the last 3 corrections or something. So China always seems to be in the headlines. One of the things that I see as a catalyst, as you asked for before, to what's going on is the growth that we've seen in developing markets in this period has not been bringing emerging markets along. Now, why is that? It's because the growth in developed markets that we've seen, whether it's US, whether it's Europe, or whether it's Japan, has been by cutting imports and growing exports. And I actually have a slide on this, but this is the current accounts in the current account in the US. And as this goes down to the red, this is improving. So the current account balance in the US is improving. Now, why is the current account balance in the US improving? We're importing a lot less oil. We're doing more manufacturing here. Labor in the US has become more competitive. The dollar has been weak for many, many years. And what happens when the current account in the US improves is there are less dollars around the world for other countries to fund their oil purchases, to fund the things that they want to import. So you have the Fragile Five, as Randy mentioned, are countries which really have current account imbalances that they now can't fund with dollars because the dollars just aren't there because we're keeping them at home. So we have sort of had this de facto tightening by improving our current account in the US. And what's interesting is like I said, is it's also happening in Europe. Basically, if you looked at the current account in Europe over the last year or so, it's improved dramatically. Europe has just basically stopped importing anything. So, and then Japan obviously weakening its currency. The yen has gone from about 80 to 102, so that they're importing less. So all of this is happening. So normally you'd see developed market growth bringing developing markets with it. In this period, because the current accounts are actually improving, that's a negative for developing markets, and that to me has been the catalyst.
Before we get to that, I wanted just to, for example, is there something in this I wanted to ask Lúcio, something that these economies could have done, for example, in terms of fiscal adjustment, adjusting their own national accounts, that could have put them in a better position or a stronger position, to weather exactly this type of volatility that they are seeing now? Because there are some bright spots, and I would mention Mexico, for example, but I wanted your opinion on that.
Allow me to start by making the point that this is not something that is happening aleatorily, right? You do have something that acts as a catalyst of expectations, and then you have this sort of a reaction across emerging market sovereigns. This obviously is a question of tapering. If you look at what has been happening in terms of capital outflows, for instance, and the Federal Republic, Brazil actually is a good example of that, essentially what has been happening in the past 3 months is just a return to the level of capital inflows that they had when quantitative easing in the United States happened. The causality, therefore, goes like this. You have a return to growth in major developed economies, not only the United States, but of course Europe and Japan too. The implication of that is that the sort of massive liquidity creation that you had out of central banks in developed economies stops being necessary. That's the logic of tapering, right? Situation here becomes better, so you don't need to continue flooding markets with liquidity. You could not find investment opportunities for all this additional excessive liquidity here, so it goes to emerging markets, right? What we are observing in a way is a reflection of the normalization of the monetary policy that we have in the center of the financial global system, the United States. And therefore, this in a way was to be expected. If you look at what we were putting out in terms of our sovereign outlook as late as in November of last year, we were already pointing out of the dangers for emerging markets of this uncoordinated process of normalization of monetary policies. What is happening in a way is completely foreseeable. It's part of the adjustment processes that sovereigns across developing economies would react to this normalization of monetary policy in developed economies, and especially the United States. Of course, developing countries are not defenseless bystanders that are going to be hit when the wave of money comes in and when the wave of money comes out. All countries have buffers, all countries have monetary policy tools. Floating exchange rates, as a matter of fact, are one of those tools that countries can and are using to defend themselves. If you look at the reactions that we have now compared to earlier, for instance, Latin American crisis, when you had harder exchange rate regimes, the impact was much stronger because you didn't have the adjustment mechanism which is provided to you by the floating exchange rate and the interest rates. Countries not only have that now, because basically all emerging markets, with the great exception of China, are floaters, but they are also in a situation in which the amount of hard currency reserves that they have, with notable exceptions like the Argentinas and Venezuelas of life, are much higher than when the previous waves of crisis in emerging markets happened. Think of the Latin American crisis of the 1980s. Think of the Asian crisis in the 1990s. The situation now is that those countries first are floaters, so this cushion the external shock, and they have hard currency reserves which are high enough to enable them to cushion the shock. Now, of course, this is a generalized story. You have countries which are comparatively more vulnerable. That's for instance, the situation in Turkey. When you use the metric of what we call our own external vulnerability indicator, Turkey was exactly the guy that was more vulnerable to start with. Therefore, no surprises, is the one that is hit harder. So in a way, what I'm trying to convey here is that this was to be expected. This is a normalization of the process of monetary policy easing. We should have expected something like that. But the countries, they developed certain types of tools and developed certain types of cushions, which they are using now, and they are preventing them from having a similar situation to what we had in the 1980s and the 1990s.
So in your opinion, for example, the way most central banks have responded to this, and most of them have responded by raising interest rates, some have been very active in the currency markets, trying to, if not, contain at least the speed in which currencies get devalued. has been the appropriate measure? Because the Fed has been telegraphing for quite some time that it was going to start tapering. And we've seen actually here in the US Treasury market a big hiccup in May last year, when the Fed said, now we're going to do it.
That's a very good point. If you look at the way that countries reacted, some of them actually started adjusting their interest rates as soon as the tape entrance. The Federal Republic, Brazil, is the country in emerging markets which actually started this gradual adjustment of their interest rates. A country that didn't do this because of governance policies in terms of their monetary authority, Turkey, was forced when the actual hit came to do this in a much more significant way than countries that started the adjustment earlier. Again, depends on the reaction function of your own monetary authority, because of course we all knew this was going to be happening. We cannot claim that we could expect negative real interest rates to be there forever, right? We all as market participants, we know that this was something that was going to change at some point. Some of the monetary authorities were able to operationalize this process of adjustment, and they started earlier, and therefore they have been hit less than other countries. And if you allow me a point, one of the reasons why they can intervene in foreign exchange markets, providing liquidity when you have this sudden stop of capital flows, is exactly because they have much higher hard currency reserves now than they had 20 years ago. The Central Bank of Brazil can provide dollars to Brazilian investors because they have the dollars to start with now, right? 20 years ago, that wouldn't have been the case.
I just wonder, though, some people, because the street seems to be a bit divided when it comes to whether the Fed should, especially in the last meeting, mention or not, the volatility and the troubles in emerging markets. Because in the past, the Fed has, late 1990s and early, in the past decade, when you started seeing problems when Argentina devalued, we need to, it was more upfront about its own role in creating and helping stabilize, markets outside of the United States. It did not do this last month. So just basically send a message that, some people see it as the Fed saying, we don't think that the situation is so dramatic that it warrants our involvement somehow, or others seeing our focus in the United States, you are on your own now. I mean, my question is, the Fed is out of the picture, it will be, and will keep tapering. So what happens from now in terms of what would be necessary to see a stabilization of fund flows into at least if we stop seeing them leaving so fast or bringing flows back to emerging markets? Please.
I think when we ask investors, when we interact with them and ask them the question, okay, what would make you come back in? The first response is they want to see stabilization of growth. We ourselves keep revising downwards our growth projections. Over the past 3 weeks, we have cut Argentina, we have cut Brazil, we have cut Venezuela, we had Chile actually, so good and bad stories. We had Mexico, this is in Latin America. Elsewhere we had cut in Turkey, in South Africa, China. Asia seems to be the one region doing better. But there is still a sense that the inflection point hasn't been reached yet in EM, and this generates anxiety. And unfortunately, as we discussed in the first part of this discussion, these market pressures, the fact that central banks are being forced to hike, if anything, it may perpetuate these negative dynamics of further dampening growth. So first, you need to see that. Hopefully, this recovery in the developed world eventually will provide this pull factor. It hasn't yet, and so far the elasticity of imports of this recovery is being very shallow. The projections that our DM economists have is that it's going to become more important as the recovery progresses. But maybe this is something that we may see in the second half of this year or even in 2015. So up until then, EM may not get much of a break. And then the other issue tied to what Lúcio said is that we need to see more outflows, or if anything, we need to see a rebalancing of the relative prices between risk in emerging markets and risk in the developed world. Because all these capital inflows that we saw on the back of quantitative easing in the US and very easy monetary policy conditions basically in most of the developed world, all this money that came in push interest rates, both nominal and real, to levels that were not really in accordance, not sustainable, and we're not in accordance with EM fundamentals. And we're seeing that repricing taking place right now. If you look at all the currencies that depreciated the most, the Turkish lira, the South African rand, the Russian ruble, the Indian rupee, etc., 6 months ago, all of them had negative interest rates, real interest rates. So no wonder why, at the moment that the Fed starts talking about tapering, people, for the exit, you have no cushion, no defense for the currency. Now we've seen bit by bit real rates turning positive. There are still several that are negative, or some very close to zero. The Mexican peso, for example, we all love Mexico. Mexico is doing a great job, past reforms, yet the peso is still under pressure. And everyone's like, why? And our own forecast was not met last year. And it is that Mexico, maybe Banxico made a mistake of cutting twice last year, bringing the policy rate from 4 to 3.5. Inflation is hovering around 4 in Mexico, a little bit above actually. So the real rate is negative, in the short end. So there's no defense for the peso. So this is an adjustment that needs to take place. So unfortunately, I don't think that the time is yet, we're there yet when investors are going to be willing to come back. They are going to want to see higher real rates and a little bit of better growth dynamics.
But what happens, one area that people tend to focus on the sovereigns, on the countries themselves, on the currencies, but some of the biggest borrowers in emerging markets in the last couple of years have been emerging market corporations. Actually, I think the number in the last 3 or 4 years, I think emerging market corporations basically borrowed on the taper, on the cheap money, almost $1 trillion, and like 70 or 80% of that is non-bank debt. So if rates now go up here in the United States, what happens? With these corporations that are sitting on higher borrowing costs in the United States. So they borrowed in dollars, their currency is much weaker now. So what happens at first? What tells you about the equity markets and the outlook for these companies, hugely indebted, and also even if we could see the spillover from, because they've been the biggest carry traders in the world. So what happens, for example, even in terms of ratings and credit ratings, and if we could see a massive wave of corporate downgrades throughout emerging markets?
We can make one point on that. We should remember that the large emerging market corporations that go and leverage themselves abroad, they usually are what we call naturally hedged conglomerates, right? In other terms, they usually have an inflow of hard currency which roughly would match the expected payments of this additional leverage, right? It is true that we believe that there is a significant amount of foreign currency leverage in emerging market corporations. We are not exactly sure of the overall size of the exposure, but again, most of those corporations, they are the larger ones that have international operations, right? So you have this rough hedge between their income as corporations and what they are paying in terms of debts.
So you mean like the Petrobras's that are already borrowing dollars?
Yeah, but it's not your corner bakery who sells bread and receives Brazilian reais that is going abroad, right?
Understood.
It's the Votorantims of life, is the Vales do Rio Doces, is the Petrobras. Same thing with Pemex, for instance, right?
But aren't exactly those companies that tend to be the ones that, especially, the biggest weightings in stock markets when people buy, especially foreign investors investing in places like emerging markets, they tend not to put the money in the corner bakery. They would go for the Votorantins, the Petrobras's, the Pemex's, and so they tend to be also highly visible. So I just wonder if, how there's a deterioration in their balance sheets too. I guess that's the point, and I believe it's fair when we say that there's been a deterioration in corporate balance sheets as well. So how do we get out of, if corporations can grow, where is growth going to come from? China?
Well, I think that obviously what we've seen is that the growth has come in the developed markets. And what you see from developed market corporations is they're actually struggling in emerging markets recently. So whether it's Diageo in Europe or Unilever, they're having trouble selling through to Latin America right now. Colgate-Palmolive took a write-off because of Venezuela. So there's a challenge going that way. And the question is will the Vales of the world be able to sell through to China going forward? And I think that any time that you bring on tremendous amounts of leverage in a short period of time, there are risks associated with that. And one of the things that I saw, which is another chart that I'll bring you here, which is developed market banks' exposure to emerging markets in the top left, and then to Turkey specifically on the bottom right. And I think that one of the things that, I look back at long-term capital and the Thai crisis that started in Thailand and ended in Russia and then made its way to Connecticut, and as you mentioned, had a response from the Fed, is that risk hides in funny places, and you never know exactly where the risk is. And one of the things that shocked me when I looked at these charts was that France has a lot of exposure and has increased its exposure to Turkey pretty dramatically over the last 5 to 10 years. And in fact, the European banks in general have increased their exposure to EM a lot in the last 5 to 10 years. So that's not predictive, but it suggests that there are risks out there that we need to be aware of. Will that become a catalyst? Will that lead to an event? I can't tell you, but I can tell you that it certainly adds to an unstable or potentially unstable situation.
But there doesn't seem to be any signs of systemic risk. For example, a lot of people have mentioned the Asia crisis when the sell-off started, and to be honest, I find that an unfair comparison. I think there's very little, that can be compared. But I wonder for Lúcio, if you think that there are real systemic risks brewing, for example, from bank exposure to some countries where you could see potential, further devaluation, or some companies or some banks failing, if that could somehow spill over here to the United States or to Europe.
First, a remark on the growth difference between developed and developing countries. What we have been observing is just a reduction of this growth gap between mature developed economies and developing countries. Developing countries are still growing much faster than developed economies. So the underlying growth story for developing economies remains there. We have seen a reduction of the gap, roughly half. So from the good old days of 2008, 2009, when they are outperforming developing economies by 6 percentage points per year, now this is only 3, but this is still 3 percentage points more, all right? They are growing much faster than us, and they have underlying strengths, flexible exchange rates, hard currency reserves, which provide them with buffers. I am very sympathetic to the notion that history doesn't repeat itself. So we are not seeing Latin America 1980s version 2. We are not seeing Asia 1990s version 2. This is going to be something different. This is going to be systemic. It's not apparent to me that the channels of exposure, they are going to be the ones that we had from what I would call the last war. For instance, exercises that we were doing just about a year and a half ago, looking at exposure of those French banks to periphery Europe, right? Which ended up being something that essentially the banks in the euro area were capable of accommodating. We should remember that economic agents, they have ways to react to this sort of exposures. They reduce their exposures, they switch them. A bank that is now exposed to Turkey, I can perfectly see them going back to Portugal, right? Or going back to Spain, because the situation clearly has improved. Economic agents will react to those changed circumstances, and we all will adjust. I have, therefore, a degree of healthy skepticism to the notion that we are fated to have a emerging crisis, real crisis.
I would add to that a lot of the issuance that has happened from emerging market corporates abroad in foreign currency over the past few years, basically since the crisis when QE was adopted, has been medium to long-term debt. So it was not, if you look at the maturity profile over the coming years, it's actually quite quote-unquote manageable, right? So you don't have a big bunch of maturities this year, next year, or the following even to really raise what you call, the risk of systemic problems or a crisis here. That is one thing. Second, that it is not that capital markets have closed for emerging issuers. Let's remember that in a month like January, as complicated as January was, with outflows that I already mentioned the numbers, with equity markets, currencies, everything falling, emerging market issuers, both sovereign and corporate, were able to issue record levels of debt in the month of January. 38 billion on the EM corporate side, 27 billion on the EM sovereign side. So you would think, okay, who's buying, you know? And the reality is that we are in a world, still this is a special world, which is, okay, the Fed is tapering, but it is still buying not 85 billion, now it's buying 65 billion, but it's still injecting a lot of liquidity in this world. Other central banks are nowhere near, you know, the point of withdrawing that monetary support. Liquidity, we're still flooded with liquidity in the world. There's still a chase for yield to speak of. And emerging markets, particularly with this sell-off in January, are seen as attractive compared to US high grade, US high yield, European high grade, European high yield, even you know, for you know, EM investment grade, you know, is now yielding more than European or US high yield. You know, so it is a matter of price, and if you are trying to maximize returns, you buy that. So it is not that capital markets have closed. So it is not that right now EM corporates are hitting a wall. Of course, you have individual cases, and I think that there will be a deterioration of credit fundamentals at the EM corporate level. Certainly, if you have a situation of low growth in EM, you can think that, you know, earnings potential is going to go down, at least for some time, right? At the same time, currencies weakening. Of course, if you have your balance sheet denominated in local currency, your debt is going up. So overall leverage is going to go up just because of the currency impact. And that can complicate matters for some companies, and you may see, you know, some companies in some countries, you know, hitting a wall. But I don't think that this is systemic. We ourselves are doing a lot of work on this, just trying to see whether at the aggregate level there's some conclusions to be made. It is hard because you literally need to get into every company's balance sheet in order to come up with a conclusion. But so far, what I can tell you is that the appetite for EM, you know, bonds are still there. You know, despite the outflows and despite everything we're discussing here.
But we still have, you know, this year is going to be very busy in some emerging markets, and I'm not talking about the World Cup, but that year we have elections actually also in Brazil, and I wonder, I mean, in India, thank you, and I wonder of a potential negative headlines, not completely generated just by us, by the media, but for example, a potential downgrade of Brazil credit. You know, I mean, I wonder if that is something that could really potentially, you know, make situation a little bit harder. I know that it's very difficult for Lúcio to talk about, you know, further future downgrades of.
Yes. That we just did a two-notch upgrade of a major Latin American sovereign, the Estados Unidos
the only
Mexicanos.
A-rated, yes.
So presumably you should expect also positive shocks in some parts of the distribution, right?
That is true. But I wonder if one thing that we haven't been touched much, it's instability in some of these countries, and that would bring to the discussion a couple of more, I would say, outside of asset classes, but it has an impact on everything. Security, political instability. We've seen this wave of protests, I mean, from actually turning very violent today in Ukraine, I mean, Caracas, Brazil. I mean, this level of discontent, how does that affect, you know, your outlooks, for example, the outlooks for stocks, the outlooks for bonds, the outlooks for economies, and if people are, how serious is that in your opinion, and if this could become potentially the black swan this time instead of, you know, problems with current accounts in '97?
I think that we also should be careful in not putting very different apples on the same basket, right? Some of them may even be bananas, right? The particular situations that you quoted all have very different underlying drivers. What you have in Ukraine, for instance, is clearly a political crisis between a government and, I would say, its people, right? The sovereign implications of that, or the broader economic implications of that, come from this underlying tension between the government and its own society. It's not apparent to me that you have a common wave of discontent across emerging markets in general.
How, I mean, understood. I mean, situation is very different in Brazil than it is in Ukraine. And sorry if I gave that impression. I mean, but obviously if you turn on the TV, you see problems in Ukraine, problems in Egypt, problems in Turkey, problems in Brazil. Oh, there's a World Cup. I'm not sure if I want to go there. I mean, so if that all put together, it's just doesn't help much. So I wonder if there's something that can be done, you know, if you understand the question, I mean, in terms that there's nothing that, you know, on top of it all, I mean, there's a serious wave of discontent in emerging markets that I'm not sure how easily it can be addressed without some pretty, you know, forceful measures by some governments, which impact economic outlooks, I guess.
I would go back to the small joke that I made about apples, bananas, and oranges, right? You have several emerging markets, from Mexico to the People's Republic of China, in which the existence of any mass wave of popular discontent doesn't seem to be apparent to me. Again, the countries that you quoted are countries that have very specific domestic dynamics, which in some cases are far from being economic or sovereign related, and to extrapolate for that to a wave of discontent sounds to me like really a logical jump too far.
Understood. It's just because I have the feeling that it could affect people's investment decisions sometimes in some countries.
Say is that it adds to this perception that that this negativism, that EM is somehow imploding, and there's no good news out of EM these days, right? And no catalyst for anyone to change their mind and feel willing to put money to work in emerging markets. So I think from that perspective, yes, of course, seeing what's going on in a day like today in the Ukraine or Caracas doesn't help, and people make extrapolations that economically make no sense, but it is, economics is a social science, right? It is a science of economic behavior of people, and it just doesn't help in terms of confidence to have these episodes be so widespread, even though there's really no connection or commonality actually between
Allow
them.
me to make one small defense about the underlying rationality of economics, right? We're in the business of assuming that people do things for reasonable reasons, right? We put out a small piece a few weeks ago in which we try to look at the systemic importance of different Latin American sovereigns, right? Let me put it this way. What is more important for you if you are a South American sovereign, if there's a shock coming out of Brazil or shock coming out of Argentina? To no one's surprise, if there is one systemically important economy in terms of South America, of course, is Brazil, is the largest one, right? The implication of that is that you should try to understand what are the channels through which any hypothetical shock would come out of any economy into the surrounding ones. The implication of that, as you yourself pointed out before, is that if we are looking at something that is less pleasant than coming out of a country like Argentina, the systemic implications of that are much smaller if this is coming out of Brazil or out of Mexico, right? Because the regional roles of those growth poles is different.
I want to go back to what Luis said earlier, and he really said, listen, what will make EM investable was growth and value. When are we going to hit a bottom? When are we going to start reducing growth rates in EM? And then when is there going to be the right value? And I think you pointed out that we have seen some of the right value in EM sovereigns over the past month or so, and issuance has been up. When I look out at a black swan event for this year, it may or may not relate to what you're thinking about for the protests that we're seeing across, also don't forget Thailand, but across EM. And one of the things that I've noticed this winter, and probably if you're sitting in this room, you've noticed it too, is the odd weather patterns. I was in Brazil last week. They have a massive drought there. If you look to our friends on the West Coast in California, there's a massive drought there. There are wildfires. This is the rainy season in California. This is all of the produce regions around, I guess, around this hemisphere, around North and South America. And you begin to wonder what happens to food prices. I always think that all major protests actually come back down to food prices. And if you look at the Arab Spring, the price of wheat essentially doubled, I think, over the course of, I think, the second half of 2010. The Arab Spring began at the beginning of 2011. Most major revolutions and waves of unsettled people goes back to food prices. Again, black swan in my mind is a very low probability but possible event. If that's one, that's what I would think about. But
Food shortages? You're really scaring me now.
No, I'm not saying. I'm just saying, with weather, I look at it.
On top of it all.
No, I look at weather, and you look at crop patterns, absolutely, and food prices.
So what? First, especially for the two of you who works with clients and have to recommend course of action, right? So what are you advising your clients? It's a tough issue. Not everybody can just leave or put their money in cash and has many assets. And a lot of people are committed to the region somehow or to the. So what are you recommending?
So I think that this comes back to Randy's question at the beginning, which was January a foreshadowing of events to come, or was that the event in itself? Market participants have been talking about the potential for volatility for the last 18 or 24 months. And so we've now had a 6% down move in the US equity market. Certainly global equity markets have gone down more than that. Was that it? And that's the question that we're really evaluating. And I think that after the moves in developed market equities that we had last year, certainly developing market equities didn't participate in that. But after that move, and we've been very, very overweight equities. I think for our clients, what we've been saying to them is equities are going to outperform fixed income over the next 12, 18, 24, 36 months. In a period like this, though, the question really becomes, are they going to outperform fixed income in the next 6 months? So I say to the clients, if you're willing to go to sleep for 2 years or 3 years, you're going to wake up and open your envelope and it's going to be great news. If you want to open it every month between now and then we should really talk, and you might need we might need to implement some risk management tools in there. So what does that mean? That means you may have to look at things like treasuries as a hedge. Maybe not at today's levels, but consider them if they move up a little bit more, because they've certainly been a safe haven. Do you buy puts on certain countries? Like I was looking today at the Hong Kong ETF. Volatility is very low in Hong Kong, but a lot of exposure to China. So if there's any China volatility, which I think would be a catalyst to global market volatility, I think Hong Kong is a great way to hedge yourself. In terms of, where is the risk reward best globally right now, I don't think that equity market participants have found value across EM, but I think that there are certain companies, to your point, that are really values right now. You can look out there. They are there, and I think we've mentioned a couple tonight that look very, very interesting at current levels, and certainly based on a longer term fundamental standpoint.
When you mentioned, especially because you focus on equities, and we've seen quite a considerable, we can say a correction in some places, because we had seen declines of over 20%. So does that mean that somehow these prices were overvalued? How would you characterize? Are we closer to fair value now, undervalued, or we were overvalued before?
I looked at PEs across emerging markets, just price to earnings multiples across emerging markets, and what you see right off the bat is that price to earnings globally in emerging markets look cheap. And then once you back out financials, which are mainly the big Chinese banks, which nobody has a lot of faith in terms of their accounting or transparency, so they trade at a very low multiple. I don't invest there, but that's the perception along Wall Street. So those end up with a very low multiple, and if you back those out, and then you back out the energy companies, which tend to be either very big Russian companies or state-owned or state somewhat controlled enterprises, which also trade at a low multiple, you look at EMX, financials, and energy, and you come up with a multiple that isn't yet at a value level. It's a little bit actually above its long-term average. So that, again, going back to your two tenets of value and growth, we're not quite seeing the value there yet. But I think with specific companies, I think that whether it's region, country, or company, you have to be very specific this year. You have to be more risk aware, not necessarily risk averse at this point.
Luis, you have some top picks?
Well, on the fixed income side, the type of investors that we deal with in my group is people that don't have an option. It's not that they can sell bonds and move to equities. Well, some might, but they need to stay in fixed income, and it's like, okay, what do I choose? Where do I put the money? What we recommended right now, where we think is probably a safer place to be, is in hard currency debt, meaning dollar-denominated or euro-denominated debt. And this is because you're not exposed to the currency risk, and we're seeing, as I mentioned earlier, still a lot of appetite. Every single deal that comes, is 3, 4, 5 times oversubscribed. So technicals seem to be more favorable there. There seems to be demand and willingness to absorb that supply. The supply itself is not going to be massive, and that's good news. So I think that's probably a good place to be. And there's a yield pickup over comparable asset classes, dollar-denominated bonds in the US or Europe. So for corporates, for example, when you look at investment grade only, so you have almost 130 basis points of yield pickup, compared to US high grade, so why not, And the complicated part is in the local currency bonds, and that's where we have an overweight in currencies, EM currencies. If you look at where we stand right now across EM, the only 2 currencies where we're expecting appreciation from now to year end, which of course is not going to be straight lines, it's going to be a lot of volatility, is the Mexican peso and the renminbi, the Chinese yuan. We expect weaker levels across every other currency in the planet, across EM. So that doesn't bode well if you want to invest in local currency bonds. Of course, you can be tactical, and I look at Brazil. 2-year paper, is yielding 11-12%. I don't think that the currency is going to move that much to wipe out that gain. So I'm willing, maybe to buy the long end bonds or short end bonds of Brazil. But this is tactical, this is opportunistic. I still think that the BRL is going to depreciate further. I still think that there's probably more bad news to be seen in growth, in fiscal accounts, maybe the downgrade. And I should actually mention, given that Lúcio cannot talk about that, we think that there's, and it's not for...
I can say that the Federal Republic has a stable
Yeah, no, so Moody's has a stable outlook on the Baa2 rating, but it is S&P, another rating agency that has a negative outlook. They put it in June last year. We think that there's actually some good chance, it's hard to venture a probability, but I personally would put it about 50% that they do downgrade Brazil. And but I think that it would just be one notch, and because it is in BBB, it will go to BBB minus. It would not lose investment grade. And I think that at this stage, probably the market has already fully discounted that. If I look at the spread of Brazilian debt over, let's say, Mexican debt, is 80, 100 basis points above. So I think that a one-notch downgrade is fully discounted. The question is whether, if S&P does the downgrade, whether they would keep the negative outlook, meaning that there's probably pressure down the road on the rating, or they would stabilize the outlook. I would guess that if they do stabilize, let's say that they downgrade and they stabilize the outlook, we may actually see a rally or some pop-up in prices in Brazilian debt, because more than one notch is probably fully discounted at this stage. If they keep the outlook negative, well, the threat will be there, right? And maybe, hopefully, they'll provide a catalyst for Dilma Rousseff or whoever wins, to do what it takes to do reforms and to straighten the fiscal accounts after the elections.
Is it too soon to talk about the presidential elections? Do you think, in terms of the outcome, if we do have some sort of surprise, if this, could have any, positive or negative impact?
Of course, yeah. No, I think the market has, preferred candidates in every country, and markets react to whoever wins or loses, and candidates, to be fair, they have the chance of changing the perception, with their proposals. But of course, when you're trying to get elected, chances are that what you're going to be saying in a public square is not what is going to enthuse people like us here or in the market. So there's you have to take everything that gets said in an election campaign with a grain of salt. You're hoping that after the campaign is over, whoever wins announces the right things now that they have the election in their bag. But all this generates uncertainty, and that is why elections, and this is another problem for emerging markets, we have elections in so many countries across regions, and actually some of the countries that last year were the focus of pressure because they had current account deficits, they all have elections. So they all had their ability or their to respond to market pressures, relatively constrained, particularly on the fiscal side because of the election cycle.
And then just one last question here before we open to the audience. I mean, I wonder if there's anything in the developed world, especially if we could see any surprise, whether it is in terms of Fed direction or something coming from China, that could perhaps, help stabilize, the situation in emerging markets, or make it even tougher at this stage. don't know if anyone.
One of the things that I look at, and I think Lúcio can probably speak to this better than I can, is if you looked at what seems to be one of the challenges that Europe has been facing over the past 2 or 3 years or so, has been its banks. And if you listen to Draghi at Davos, he basically said that the ECB could potentially buy the bank's assets from them and provide liquidity and take the bad debt away. And I think that would be a huge positive. I would see incredible upside in Europe on that. And again, Lúcio, did you see that statement from Draghi?
Let's try to put this in the context of what the ECB as a monetary authority can actually do. The ECB, and if you can bear with me for a moment, I happen to be a European Commission official on a leave of absence.
I knew that, which is why I could speak to it better than I could.
The ECB has a mandate which is both institutionally and structurally constrained compared to other monetary authorities. For instance, compared to the Federal Reserve, it neither had the mandate to perform the operations that the Fed did here, nor it had unified markets in terms of the euro area that would enable it to have performed the bond and treasury buyings that the Fed did here. I also think that given the mandate and the institutional constraints under which the ECB operates, that the notion that they can simply go and buy the banks is not exactly a correct representation of reality, if I can put it this way. On the other hand, they have been extremely effective in terms of the provision of liquidity to the banking systems across the euro area via the 2 LTROs. And that is something that they clearly have the margin to do. If you look at the dimensions of the balance sheets of the 3 major central banks on planet Earth, the Federal Reserve, the European Central Bank, and the Bank of Japan, the one that has the margin to increase compared to the levels of the other 2 does happen to be the European Central Bank. Exactly because due to the institutional constraints that the ECB faced, it was never their default to inflate their balance sheet to the same level as the other guys. Now, there is one thing that you are referring to, which is the asset quality review that the ECB will be performing in the euro area during the course of this year. The ECB only became the legal supervisor of the banks in the euro area in 2014. Before that was a devolved capability to the supervisory authorities in the individual member states of the euro area. As a part of the process of it becoming the supervisory authority in the euro area, the ECB is undertaking, together with the European Banking Authority, a process of evaluation of the underlying asset structures of all the systemically important banks of the euro area. After that, it will perform what's called a stress testing exercise. Now, what the ECB can or will do after the results of the asset quality review and the stress testing is not apparent at this stage, and due to very good strategic reasons. No decent central banker will come to you and say, no matter what you do, bank, I'm going to be your backstop. That's not the way central banks operate, right? Therefore, I would think that the ECB will try to be as non-committal as possible between now and the late fall, when the results of the AQR and the stress tests will be announced. But our underlying expectation is that nothing will be revealed that is not within the margin of the capacity of reaction of the ECB. One simple statistics to give to you what the ECB could do. The repayments of the banks in the euro area of the 2 LTROs, the provision of liquidity that the ECB did, which were ahead of schedule, gave the ECB enough resources now, without going above the level of liquidity provision that they had before, to essentially by 20% of the deposits that you have in all the banking systems of the euro area periphery. The ECB, by keeping its powder dry, kept a capacity of provision of liquidity to euro area banking systems that far surpasses what we expect can be eventually reviewed by the asset quality review and the stress testing. I'm sorry if this was a longer, very complicated reply.
I think everybody enjoyed it.
Maybe we can take opportunity and bring the audience. Wouldn't I just ask you that if you get the microphone, you just say your name, and if you have the question specifically to someone, or if not?
Hello, my name is Sam with Xinhua. My question is, what's the major difference between China and the other emerging markets in the recent market volatility? And what's the major challenge facing China in the economy? Thank you.
Sovereign reply. China has two major differences in relation to other emerging markets. One is that it's a country that is not really financially integrated into global markets. It doesn't have a liberalized capital account, and it still does not have a floating exchange rate. Effectively, this means that the financial channel of contagion is fully absent for the People's Republic of China because it's not a country that is financially integrated into the global economy in the way that other emerging markets are. Beyond that, China does have a credible, robust, long-term growth story. China has had a significant deceleration in the past 2 years, but that implies that they fell from 10% growth per year to 7%. That is really very respectable. China still has what we can call a series of low-hanging fruits that can keep this level of growth rate around for several years still, all the way from just liberalizing the movement of labor force within the People's Republic of China. You cannot actually move, right? If you are, for instance, a rural labor in China, you cannot actually move to a higher productive employment opportunity in a city in China because they have registration systems that restrict the way that you can move from a low productivity job in the primary sector to a higher productivity job in a urban area. China still has several constraints in terms of competition that makes its productive structure very much oligopolized and concentrated in low productivity state-owned enterprises. The process of liberalization of those state-owned enterprises, essentially by cutting the link between the financing that they receive from the state-owned banks, is something that could increase the productivity of those companies very easily, with some adjustment costs, but very easily in the end of the day. This all implies that those low-hanging fruits in terms of reform and the fact that China is isolated from the financial component of the global shock does provide us a considerable degree of comfort in terms of the medium-term perspectives of China.
I have a little bit of a different reply, which is that I think that China has taken on a lot of leverage over the past 4 or 5 years, and they've done that in different ways. I think that this is the trust products. This was a report that Bernstein put out last week, but they showed China finances a lot of its projects in I guess, central government debt, local government debt, and then what they've done, some of the banks have taken on what they call trust products. And what these really are is these are packaged loans that have above average yields that the banks sell to their wealthiest clients. And I think that for anybody who lived through the CLO episode here in the US, that might sound somewhat familiar. Now, one of the challenges with these trust products is some of the underlying businesses aren't able to go out and get normal loans for themselves, i.e. they're like subprime loans that are being resold by banks. So you have these subprime loans that are being resold by banks. Recently, 2 of these things have basically defaulted, and magically some unknown authority or some unknown entity has stepped in and made the investors whole. You now have, I think, what is this? I think this market is it $1.8 trillion, and I think about 50% of it's maturing in the next 2 years. So that's a challenge in my mind. The other challenge that you have, and you're maturing into a slowing world where competing yields around EM are getting higher and higher. Not that these are for specifically for Chinese people, but the other challenge is that local and central government debt also is maturing at the same time. So I think about 54% of all Chinese local and central government debt is maturing between the second half of last year and the end of 2015. So you have a lot of debt having been taken on to provide some growth, and a lot of that debt needing to be refinanced here and now over the next 2 years, some of which seems to be a little bit more questionable, but finding the transparency is a little bit difficult. But I would call that a risk, not a prophecy.
Andrew Qualley, Sidley Austin. Could you focus a little bit on Colombia, Peru, Chile, and focus on both debt and equity markets and what exposure those markets have to foreign investors if you were to talk again about the contagion effect? What percentage of their assets are held by foreigners that might move more quickly out of those assets if things got even more troublesome? Or are they at the bottom now and they therefore look like pretty attractive opportunities?
What I would say is that they have all those three countries, which have, generally speaking, been good stories, good economic stories in recent years, certainly have received a lot of foreign capital. Of course, for investors that need to invest in liquid assets, oftentimes their investment, the opportunity set is limited to Brazil and Mexico. But those that can invest in more illiquid instruments, there's been a lot of money coming into these countries. For example, in the case of Peru, around 60% of the local government bonds denominated in soles are in the hands of foreigners. And the one thing that changed this year, and having a conversation with the team of the Central Bank of Peru, that they were a bit concerned that this is a trend that they had not seen, a development they had not seen last year, is that they had finally seen foreigners started to unwind their exposure, sell some of the bonds. And they were asking us, whether we were seeing this in other countries. And I said, well, don't take it personally. Yes, investors are fleeing local markets across the world. And in the case of Peru, so basically, when you have to sell, if you are following a benchmark, you sell whatever is in your benchmark. And Peru may have a weight of 2, 3, 5%, whatever it is. If you have to sell X amount, well, 5 or 6% of that is going to be Peru. So I said, that is what is generating part of the pressure on the sol lately. But in none of those countries, though, we think that they are anywhere near any vulnerable point or any crisis point. Central bank reserves are plentiful. In that one case of Peru, for example, the stock of reserves is like 33% of GDP. It's almost double relative to the size of the economy of Brazil, for example, even though in nominal terms Brazil is much higher. So Peru could easily accommodate, if all the foreigners wanted out, which won't happen, let's say for the sake of argument, they all want to leave, there will be the dollars at the central bank to let them leave, so without creating havoc in the currency market. So all these countries, I think that fundamentals are pretty good. I think their biggest concern right now is not that, it's China. And it is because China buys a lot of the commodities that they are selling, and they are China is not only actual demand but also commodity prices. So some of the deceleration, for example, I mentioned earlier that we reduced the growth forecast for Chile was because of the external accounts, showing the pinch from lower China demand and lower commodity prices. I don't know if you have something on the equity side.
Well, I tend to agree with you. I think that there is, to the extent that people are selling EM, what tends to happen is you have a period where everybody's painted with the same brush, and then the differentiation comes out. And right now, I think we're still in that former period, and so that we're not yet at a point, and obviously there's not a cascade in EM right now, but to the extent that there is more later this year, I think that it will all get painted with the same brush, and then those differentiations will come out. And I think that some of the differentiations in those countries are very, very positive, so that over the longer term they should bear themselves out.
Victor Rodriguez. I remember that a few years ago, Brazil created up high expectations, and now it's kind of a big frustration in the market what's going on there. Don't you think that Mexico now is creating over expectations with all the reforms and things that are happening now that can create a worse level of frustration in a few years if the things are not happen as they are, expected?
Well, certainly that's a risk, and the issue is that the reforms were passed. They went through Congress, so that was a very good work done by the government. But the devil is in the details, and we still have, for example, in the energy reform, which is probably the key one there, we're going to spend the entire of 2014 passing secondary legislation to implement that reform. So Mexico is not going to see a penny of foreign direct investment this year coming, for investment in the FDI into the oil sector. With some luck, assuming that all this secondary legislation gets passed and there are no stumbling blocks there, we may start to see the auctions of fields and projects and concessions already being announced by the end of this year. With some luck, that FDI inflows may start to happen in the second half of next year, 2015, or most likely 2016. That is why the Mexican peso is not, being too cheery these days, because it is like, okay, it's good news that these guys passed the reforms, but we're not going to see the money yet, and there's a lot of room for mistakes along the way. This thing needs to be approved. Mexico is like the US, a federal system. Every state needs to pass its own version of the energy reform that was passed at a federal level. So a lot of room there for, funny things to happen given the political dynamic. So you're right, there's a lot of hype on Mexico right now. People see it as a safe place to be, to park your money. Hopefully there won't be disappointment.
Lúcio, you would like to say anything in Mexico?
Allow me to make just one small remark in relation to Mexico, and bearing in mind that we did upgrade the country to notches, essentially based on the strength of the reform package. It's important to keep things in perspective always in life, right? I'm saying that because if you look at what the Mexicans are doing, opening up the energy sector to participation from capital, not from the state-owned enterprise, breaking up monopolies on the telecommunication sector, etc. These are actually things that another Latin American country, which has recently fallen for favor, the Federal Republic of Brazil, did 15 years ago. As a matter of fact, if you compare the level of liberalization that you are going to have in some of those sectors in Brazil now and what the Mexicans expect to achieve when reforms are fully implemented, the level actually is going to be inferior to the level of liberalization that you already have in Brazil. All right? You are talking about breaking up essentially a monopoly in the telecommunication sector. The Brazilians did that 10 years ago. You are bringing capital from eventually foreign participants into the energy sector. The Brazilians did that 10 years ago, right? The provision of the capacity of companies to bid for PPPs in infrastructure set. Again, the Brazilians did that 10 years ago. They essentially fully privatized the railway system. Now, we should keep this in mind, right? That what the Americans are proposing to do is something that in terms of the liberalization level, the Brazilians already did 10 years ago. And not necessarily with the stellar levels of growth that one seems to be imbuing for the Mexicans over there.
You all were pretty sanguine on your outlook for developed economies generally, and specifically sound like the U.S. How risky do you all see is if the U.S. Growth outlook does continue to be positive, and Treasury yields do continue to go a little bit higher? Obviously, they've been down recently, but assuming growth is good, the Fed removes some accommodation. How risky do you see higher Treasury yields, which is a risk-free asset, for emerging markets more broadly?
We are in a situation of, damn if you do, damn if you don't, almost in emerging markets, which is, the U.S. doing better is going to mean higher treasury yields, and we know that, as we mentioned earlier in this discussion, we need to have relative valuations and prices accommodate or go back to what they were in accordance to higher treasury yields. When we make the calculation, for example, before all these QE started to bring the 10-year treasuries, really down, a period that you start counting in early 2005 and you finish, I think it was like the first quarter of 2011, average 10-year treasury yield was around 4%. During this period, the real EM interest rate was around 3% real, okay? Consistent with 10-year treasury. You could think of that being some kind of equilibrium. Not that we need to go back there, but at least gives you some historical benchmark. When the 10-year treasuries went down after QE, up until the end of last year, the average was around 2.2%, and the real yield in EM was around 1.5%, 1.6%. So if we go back to 10-year treasuries to around 4%, which we may not see it this year, our own treasury team at JP Morgan, they have a year-end forecast of 3.4, I think. But we're going to see 4%. It may be next year, probably, especially if the Fed starts to hike in the second half of next year. You need to see higher yields in EM. There's no way around it. Otherwise, the currencies would just be decimated. So it is this reaching a new equilibrium level that we're going through right now. And that is why we are still telling people be cautious on low EM currencies or anything denominated in EM currencies. And this has implications also for equities, because equities, okay, you can buy the ADRs sitting in New York, but so long as every purchase of ADR involves the purchase of a local share, there will be an FX transaction that the valuation here will be undermined if the currencies weaken tremendously. So what happens to the Fed is important. And I said, damn if you do, damn if you don't, because now we're actually going through a couple of months of actually relatively weakish U.S. data. Treasury rates have actually gone down. But we're not seeing a massive appetite for EM, right? People, I'm telling you, keep pulling money out. So it is not that is providing much of a reprieve. So EM right now everyone knows that the adjustment has to come. And it may not have, hopefully it's going to be gradual. Hopefully it will happen at a pace where it will not create crisis anywhere. And hopefully governments will react the right way. But we need to go through that process, and until we're not further advanced in that adjustment of this macro equilibrium across EM, I think that it's going to be tough for the asset class to attract a lot of capital.
Question here first.
Jada, what's the outlook for India? The rupee came down sharply last year and seems to have stabilized, and the stock market is not catching this EM downfall. So what's the outlook, or is it depending on the elections later this year?
Well, there was a question earlier of whether elections matter or not. Well, that's an example that it matters. And local investors and foreign investors are putting a lot of weight on a regime. The high probability of regime change in India. Regime meaning that, the next president is going to take measures that are going to really help, lift productivity, pass long overdue reforms and help the Indian economy. At the same time, the new governor of the Central Bank of India has shifted the policy stance to a lot more, orthodoxy, have hiked interest rates and make the monetary management a lot more transparent and therefore more credible. So, and the election is happening in May, as you know. So it is already a short window. And that is why markets are thinking, okay, maybe the worst is behind. Let's just sit tight, go through the elections. We're going to get good news soon after, and that is why we're not seeing the kind of pressure that you are seeing elsewhere. Brazil is a little bit of the opposite. Brazil, the expectation is that there won't be regime change, and this, especially the Brazilian investors, are questioning that. That they say, well, how much is it possible that this same administration, will do everything that they didn't do in these past 4 years, if they stay in power? these kind of questions, they may not, we don't know, you know. Certainly they won't pre-announce it in the middle of an election because they're trying to get reelected. Announcing, hard reforms, won't gain anyone votes. So, and the election is only in October. It's, too far away. So that is why, people are more negative, investors are more negative with Brazil right now, and with India, I think that they're willing to make a bet already.
Ralph, do you have any thoughts on India?
I agree. I think that the Indian election is really the focus, and I think that investors are looking towards a market-friendly regime change, and so that's why. And I think India has really acted differently than EM, not only this year and last year, but sort of through its history. It's been it's sort of almost been a special case there. So, and I agree. I think the election's a big deal.
One other thing that I should mention is that India does have a capital control. So it is more integrated than China. China is the extreme of non-integration. But India, it is very restricted. There's a quota, and it's very easy to hit the quota, and then there's no more inflows from foreigners. So the exposure of foreigners into the Indian market, be both equities or fixed income, is relatively limited, and that also isolates the country a little bit from everything we're seeing abroad. So that, I'm sure, is also playing a part in seeing India doing its own thing.
Hi, my name is John DePunson. I have a question. It's more macroeconomics in terms of basically we were 6 years away from Lehman Brothers, and it seems that fragility is still very much a part of the world, even though they all seem to be independent of each other. How far, if you can have a forecast, how far away do you think we are from a point where these governments, US included, will not be backstopping the financial system in order to sustain it?
I obviously cannot make any firm forecast on that. And if I could, I would have a much greater amount of money in my bank account than I currently do. Now, more seriously, it's a stylized fact that crises which are caused by excessive leverage, they tend to be much more prolonged and with a much more subdued process of recovery than traditional economic crises. Obviously, what we experienced in 2008, 2009 was a financial crisis, and what we are observing now is a almost textbook, subdued, and very prolonged process of recovery. If we use as a benchmark the level of leverage that you have in economic agents in different countries around the world, we can say that roughly the United States has returned to a level of aggregate leverage, which is similar to what you had before the beginning of the process of the crisis, right? So you can think of that as an adjustment to what is similar to the historical norm in the United States. It's less apparent that this is the case in other major developed economies. The process of leverage was more symptomatic of developed economies than developing ones, with the great exception of China. China is the developing economy which has levels of leverage which are actually similar to what you observe in some developed economies. Now, if you look at what's happening in terms of the United Kingdom, a non-systemically economically important economic area, you had also a reduction of the level of leverage, but not to the levels that you had before the crisis. In the euro area is a slightly different story because you never actually had this build-up of leverage that you had here in the United States, so they have less to go down to return to their normal level. By those metrics, at least in the United States, one could hazard that you are very close to pre-levels of leverage and use this as a benchmark for normalization.
Any more questions? Oh, I have several. Here and then the lady over there. Sorry.
Can you comment the situation with the Russian economy? Currency is obviously is under pressure, but at the same time, total government debt is 10% of GDP. There are, oil markets, oil prices are rather high, and at the same time, there are huge currency reserves. So how can you comment the prospects of the Russian economy? Thank you.
You are correct in pointing out that the classical saving grace of the Russian sovereign is its very clean balance sheet. It's actually one of the investment grade rated sovereigns that we rate with the lowest level of government debt. That is something that has been acting as a buffer for Russia since the cleaning of the balance sheet that you had after 1998. Now, but Russia, in the end of the day, remains being essentially a commodity play, right? If you remember what we were discussing before, the underlying dynamics of commodity markets around the world, which are not only related to the deceleration of Chinese growth, but also to the maturing of the Chinese economy, right? When you become a more developed economy, the intensity of commodities that you use for a unit of growth actually falls down. You build less bridges, right? So you buy less steel, you buy less coal, you buy less oil, right? You buy more vacations in Hawaii, right? You switch your consumption bundle. Now, if we assume that that's what is happening now, parallel to other shocks in global energy markets, the shale oil revolution here in the United States, the tight oil or the pre-salt reserves that you have off the coast of Brazil, this all implies that the forward-looking expectations in terms of energy prices is slowly downward sloping, right? Because Russia is a commodity play in the end of the day, 60% of the revenues of the Russian government, around 3/4 of your exports are commodities broadly defined. Just this adjustment in the expectations of what is going to happen to energy prices affects the Russian sovereign. And that's the channel through which you are affected.
Sorry. You.
Thank you. Camila Torrente. I have a question for Ralph. You were talking about EM differentiation and how correlations tend to be high when there are sell-off episodes like the one we've been seeing. But don't you think like investors are already looking at how countries like India, for instance, are doing better in terms of balancing their external accounts? And do you think they have started to award a better perspective on those markets, or correlations are still high? And a question for Luis. You were talking of how there are some like mutual funds that have this LATAM mandate, and they can't trade very much of Colombia, Peru, or Chile. And there has been this view probably that Mexico was also helped by the fact that Brazil was doing so bad over the last year, and Mexico is extremely illiquid and expensive right now, while Brazil, it's not at very cheap, but cheaper in relative to other EM markets. Do you think, what could be a good surprise coming out for Brazil that could make investors turn around and look at Brazil? And since the Mexico perspective for this year is very like flat. Thank you.
All right, so in terms of EM differentiation, I think that you start with just going back growth and value. And so that is the differentiation coming? I even look at an economy or a market like Russia's, and you look at primarily the Russian benchmark is big commodity players and big Russian banks. And I would also probably throw in there corporate governance in addition to growth and value. If you were to look at a Russian internet company like Yandex, that's going to trade at a premium multiple. And that's the same thing that you see this often in Brazil, where you basically have the consumer companies that have higher growth prospects and less sort of room for government regulation, trading at a different PE than you have maybe the banks, utilities, energy sector, some of the commodities, and other areas where the government has shown an appetite for involvement. So there's a differentiation there. And then you're seeing that differentiation in countries as well. I really think that India is a lot about the election. And so it's a very specific case. There are the capital controls there, but I think there's a lot of anticipation for reform. We see something similar in Mexico. So I guess to your point, we are seeing some differentiation there. I think that we've all seen that in a crisis you correlate to one, unfortunately.
To answer your question, if you look at Brazil was the darling of the market not too long ago, 2, 3, 4 years ago. Everyone wanted to invest it there. It was the higher yields in the planet. The currency was appreciating. So it was, you got not only enjoy the high domestic interest rates, but also the possibility of appreciation of in local currency of your investments there. That prompted the authorities to adopt this infamous IOF tax, 6% that you had to pay up front, just to, basically the ticket to come in. And there was a no-go for a lot of investors who didn't want to be forced to stay there for a long time, just to be able to amortize, quote unquote, that 6% IOF. During this period, interesting enough, there was a lot of, because people didn't want to pay the IOF, we stopped seeing the massive inflows into the local market in Brazil, and we started to see massive inflows into Mexico. So people look for what is the next liquid market where I can invest. And we have seen Mexico that at the time of Lehman, which is 08, 09, around 12-13% of the Mexican local bonds were in the hands of foreigners. Well, since 2010, it went up significantly. Right now, we're talking about 36% of local bonds in the hands of foreigners. The entire stock, if we just look at the fixed coupon bonds, it's over 50%. So it was held because, Brazil had put this gate. Now, Brazil lifted in June last year the IOF. It's back at zero, right? I mean, they needed to attract capital. Now people actually wanted to get out. There's been now new inflows, but now the story in Brazil is very complicated. People want to hear exactly what's going to happen with the elections, what's going to be done after the elections. So we're not seeing much appetite for Brazil these days. Mexico continues to attract inflows, but people are also, you do hear the sense that, okay, like the other question, maybe too much hype with Mexico. Maybe as much as, okay, we went from Brazil being the darling of Latin America to Mexico being the darling. But Mexico, now maybe at least we can get the feeling that it's fully priced. All the good news are already in the price. So what's next? And we do get the question as to, okay, maybe if you sacrifice a little bit of liquidity and are willing to go to smaller places, you can actually find value and better places to invest. And we're seeing more money, and we have seen that already, coming to Colombia, coming to Chile, coming to Peru. In Colombia, Colombia had its own version. There was no IOF, but it was a very hefty tax, 33% withholding tax for foreigners that invested in local bonds. That was reduced last year to 14 only. So now there's more appetite, and we have seen the share of foreign holdings in the local bond market increase, still low from 6 to 8%. So in Mexico it's 35, 36, so, but it probably has the potential to go. And I think that the same thing is happening on the equity side. My interaction with equity investors is marginal, but when I speak to them, they do say, okay, Brazil they don't want to touch, right? Mexico is expensive, all PE ratios, comparables, it seems like all the good news are in the price. They're also looking for somewhere else if they want to have exposure to Latin America. The complication there is a little bit different, which is, okay, how to have exposure to Latin America without having exposure, let's say, to commodities, if you think that commodities is going to go down. It's not that easy, because most of the names, that companies that have, liquid equity stocks out there, tend to be commodity-related companies. So you have a very small subset of where you can eventually invest. But that is happening. So I think that there is an opportunity for, and this is what we tell issuers, companies that are more reliant on domestic demand, that are not linked to commodities in some of these countries, to really look to come to market. There'll be a lot of appetite for having exposure to these good economic stories that are separated from having exposure directly to minerals or oil or agriculture.
So we have room for one more question. The gentleman here, he's been asking second row, sorry. He's been
Thank you. Adam Nilsson is my name. I think of trade on one end and finance on the other a little bit. And if we look at Mexico, we see that they have this voracious neighbor, the U.S., that buys a lot from them. And I think that's really helped them as we see the U.S. recover. And then when we look at Brazil, we look at two of their large trading partners, Argentina, who's in pain, and China, who purchases a very large amount of their commodities, soy and corn and those things. Can Brazil get back to strength if China is moving slowly the way that they're moving now, or if Argentina is in pain? I'd just like to hear your opinions on that.
If you allow me to start by making a factual correction. The second most important partner of the Federal Republic is the European Union, right? A market which is expected to grow faster and which is in the process of negotiating a free trade area of Mercosur, to which incidentally Brazilians were pushed because of the negotiations between the European Union and the United States. Mercosur, actually, the whole of Mercosur beyond Argentina is a relatively small part of the export say destinations of Brazil. Now, as all major continental countries, Brazil actually is a rather closed economy, surprisingly closed as a matter of fact, much more closed than Mexico, which leads one to conclude that the underlying most important dynamic factor for Brazilian growth is Brazilian domestic demand, right? Which is another way of saying that and I'm not trying to be comical here, the problem of Brazil is not China's Brazil, right? There are certain constraints in terms of medium-term growth for the Federal Republic, traditional ones that have been there historically for the past 200 years. Is a country that has a very low level of domestic savings, and that translates in a very low level of investment in general, and therefore exposure to inflows and vulnerability to inflows and outflows, which is not present in other emerging markets. At the same time, is a country that has grown for the past 10 years, not via investment, not via the Chinese model, if you will, but via domestic demand, bringing large segments of the Brazilian population which were outside of consumer markets to consume, which of course is obviously socially desirable and which increases, theoretically at least, your political stability. Now, this has natural limits, right? Because you cannot keep on increasing the level of leverage that the Brazilian households have. We all know how this story is going to end, right? So the basic question here is more of a change in domestic growth model away from consumption to investment, which has proven to be very difficult, structurally speaking, for Brazil for the past 200 years.
Just to complement, I completely agree with what Lúcio said. You have the problem with Brazil is that the growth model is certainly being exhausted, and the reason why it is still one of the most closed economies in Latin America, exports is only like 11-12%, actually similar to the U.S. In the case of Mexico, exports stands at above 33-35% of GDP.
30% of that are to the United States.
Yeah, and 80% come to the U.S. Yeah, so it is true that Brazil relies a lot more in the domestic market, but Brazil, the way in which it is quite a protectionist model that makes everything that gets produced in Brazil be very expensive, unable to compete internationally. For example, you have, with an example, Honda. Okay, Honda wants to sell cars in Brazil. The government will tell Honda, okay, come build a plant here. We'll give you tax breaks, incentives. But we're going to ask you to please try to source as many parts as possible out of Brazilian suppliers, the rubber for the tires and the plastic and the leather and whatever, so domestic content as much as possible, so you generate, a very, interesting, supply chain and generate industrialization of sorts, in a kind of, I don't want to say forced way, but it is a very, very strong, inducement from the government. The result of that, however, is that the car that Honda produces in Brazil is very expensive. I remember when the BRL was around 160, which is whatever, a year and a half ago or 2 years ago, asking how much is the price of a Honda Civic produced in Brazil. It was 66,000 reais, which was around $40,000 at that time. I mean, what is the price of a Honda Civic in this country? I mean, the US is probably 15,000, So you are paying for all the inefficiencies of the entire supply chain of Brazil in that car. Can Brazil export that car? Maybe through Mercosur to Argentina And that's probably about it. I mean, Colombia, Peru, they won't buy. They're going to buy from Mexico and certainly from Japan and the US, so that is a problem. So how are you going to change that? You need to expose the Brazilian corporates to more foreign competition, but of course that transition is going to be costly politically and economically because it will take a lot of time for the domestic corporate sector to really be exposed, to foreign competition. So, but these are the kind of reforms that need to be passed. That's why growth is so dismal. And I agree. You need more investment. And investment, I don't know where it's going to come. Who's going to invest if you have that cost structure that is so high? And whatever you sell, unless you sell it to a Brazilian, in a protected market, you have no hope of competing abroad.
So after 1 hour and a half of debate, I think it's maybe fair to infer that there's still some volatility ahead. There's pain still in some countries, but we're definitely not going to see a repeat of. This is not a repeat of '97 or '98, even 2002 in Argentina. But I want to really thank our panel here: Lúcio from Moody's, Luis Oganes from J.P. Morgan, Ralph from Itaú, who graced us with 1 hour and a half of discussion into some very good questions from the audience, and we are, in the America Society also for hosting us, and the debate is always open here in this venue. Thank you.